what I'm seeing is really interesting. I'm seeing a lot of younger investors, kind of the light bulb go. Like, I want to subsidize my lifestyle now, whether I could for a phone bill or daycare or a car payment. Like, if I can generate that income now, that's less time I have to work. I think there's more emphasis on living in the now than waiting for retirement.
This is the Passive 25K podcast, a podcast built around the vision of creating wealth through passive income for ourselves and others. The idea of creating income while you sleep seems like a dream come true, but for most professionals, turning this into a reality is a different story. On this show, you will hear real people breaking passive income streams down to the basics, giving you the next steps to start your own passive income journey. If you're new to the show, my name is Kyle Reedstrom from Fargo, North Dakota, where I get to work with my team of agents and investors each day to complete our goal of $25,000 a month in passive income. Now, let's get right into our next conversation. This is the Passive 25K podcast with Kyle Reedstrom. We are the home of Passive Income University. We help working professionals with one source of income start and complete their passive income journey. Find us at p25kg.com. And if you're looking for next steps, click that button. Let's talk about your game plan. We love having those conversations. Today on the podcast, we get to have a new conversation, a brand new conversation we haven't talked about before, mortgage note investing. A really unique solution-based investment strategy. 7E Investments is the company, and Lauren Wells is the vice president there and our guest today. Lauren, we're delighted to have you on the show. Thanks for being here.
Yeah, thanks so much for having me. I'm excited. I've listened to a few of your podcast episodes and I love what you guys are all about. So excited to talk about something probably most people have never heard about.
Yes, I think that's exactly what I've got the excitement for today. We're going to build it up. Hopefully our listeners are sitting here like, okay, they're bringing something new, which we do. That's our goal here, is to try to have these new conversations around new revenue streams, this is exactly that. Lauren, you're the VP of Investor Relations and Strategy at 7E. You've been in the real estate game for a while, over 10 years, got an active family with the husband and 2 boys. I'm excited to learn about mortgage loan investing, but give our audience a little more intro about you so they know who we're talking to.
Yeah, so I actually really resonate with your podcast because I used to be someone who worked in like that corporate tech startup life. And as did my husband, we went to UCSB, go Gauchos, and both, stayed in Santa Barbara. And it was right when tech was booming, went into tech. I went into the sales and development side and went into product management. And it wasn't until about 5 years later, after I had done tech, started my own consulting business and everything in between, that I realized that really there was kind of 2 ways to grow wealth. I could continue to try to make more money and decrease my debt, so spend less and budget, or I could create another income stream. And at the time, looking around, everyone who I saw successful, who really owned their time, which I feel like most people really want, did that through real estate. So I went kind of the traditional route at first, where, you buy a property, you rent it out long-term, rental income, even if it's just a little bit to cover the mortgage and then some. But mortgage notes was a random, random at the time, concept that kind of got thrown at me by someone I was mentored by, or someone I considered a mentor. And so I looked into it. They had said that they were about to retire. This wasn't something they were willing to get into right now, but this is something that they would look into if they were me. And so that's kind of what started me down the mortgage note path. And I essentially built my own portfolio and then met my current business partner now, Chris, and through 7E kind of started offering the same income investment option to investors.
Wow, that's really cool and neat to hear. You had a mentor that was like, hey, I think I would do this if I were you. I'm just not, this isn't my season, but like, check this out, Lauren, right? Like that's pretty cool.
Yeah. My wife will murder me if I start a new venture and don't work. And so, so it was really good. I'm a big believer in networking and mentorship, especially if you're looking to invest, whether you're passively or actively. And I think it served me really well.
Oh my gosh, I love that you touched on that. I got a tangent into that. You guys, relationship capital is a big part of this whole journey. Passive income, investing, business, everything. It's not just actual money, actual capital. We're humans interacting with humans, coaching, mentoring, connecting with people that are aligned with you has been a huge catalyst for me. Lauren, you'd agree?
Yeah, definitely. I think even now, we're in like a different phase of the business, and it's connecting with other businesses and other people who are on like the same playing field. I've always had a business coach. I've always been part of masterminds and surrounded myself with people who are on a similar path or have similar goals. You can always learn something from what they're doing that you might not be.
Yeah, and for people that are impatient, if you want a speedier version of this, find someone that has done what you would like to do and get on their wavelength, get in there, get time with them. It's oftentimes not as hard as you think. I always encourage people to reach out to authors, reach out to people that are speakers, things like that. But your website is 7einvestments.com, and there's an awesome little video on there that explains mortgage note investing. That helped me. I was like, okay, this is cool. A little 2 or 3 minute breakdown. But let's answer this right out of the gate. What is it? Give us your explanation of mortgage note investing.
Okay, so the basic way I understand it, basic way I'll explain it, other than watching that 3-minute explainer video, which is awesome. I love that feedback because we literally produced it a few months ago and it's gotten great feedback. So
yes,
essentially anyone has probably watched a HGTV show where they fix and flip homes. So I'm going to compare it to fixing and flipping homes. We fix and flip mortgages. So what I mean is we're essentially purchasing a distressed mortgage. So someone who maybe hasn't paid in anywhere from 90 days or more. We are working with them to get them paying again or restructure their note. And then which increases the value, similar to putting money into a property that probably was, less than ideal. Because of that, we're getting it at a discount when it's purchased. We're putting value into it by getting the borrower, to pay again or to perform. And then we are selling it back on the secondary market for a, 90% loan to, or just 10% discount versus us having bought it for like a 40%. So again, similar to kind of fix and flip, except for we don't have to touch the property. We just have to work with the borrower.
Very cool. Very cool. Okay. Now these are, like you said, I love the analogy here with fixing and flipping properties. Everybody can visualize that.
Yeah.
So now we're talking about a mortgage note. This is a mortgage on a house. Obviously, there's a tangible asset with this, and it's not going so well, right? Like you said, this is a distressed mortgage. So, AKA something happened with the family. The payments just haven't been made. What are the situations that you guys are using? I mean, that's the situation, right? You're coming to that scenario.
Yeah, so I think there's a lot of things that kind of go into this. I think there's a big misconception that people just wake up one day and be like, I'm not going to pay my mortgage. Sounds like today's day, this is the month. And 90%, we've done over 500 deals. 90% of those, that's not the case. So what I mean is typically the issue or thing that caused them to stop paying was something like health, death, divorce, job loss. It could have been the borrower died and it passed to the family, or something as simple as, hey, my loan's been sold 10 times and I didn't know where to make payments. That's happened way more than you think. And those are like wins. So really what happens is these people fall behind. So I'll give an example. We had a borrower who was $30K behind on his payment. That's a significant amount depending on where you live or anywhere really. $30,000 is quite a good chunk. And when a bank is servicing a loan, they're going to go, okay, in order to start making payments towards your current due payment and not your behind or arrears, your 30K and late fees, you need to get caught up with that 30K. There's really zero flexibility. Banks are very, very good at creating debt. They're absolutely awful at managing debt. So That's where we step in. We're purchasing these and we're able to work with the borrower. So this borrower specifically had undergone health treatments that they had to get done, which caused them to be that 30K behind. By the time they got back to being able to pay the monthly payment, the bank said, nope, sorry. So when we stepped in and kind of assessed the situation, we were able to put him on a trial payment plan saying, great, you go ahead and make 6 months of payment. We'll apply them towards your current due. And then we'll work on a payment plan for the arrears, whether that's quarterly, whether we're adding it onto the back end, or whatever that might be. There's so many different, I guess, exit options or strategies that you can use when working with borrowers that it's something I really love about Note. There's not like one.
Yeah, that's really unique. And this goes into, I know I'm going to touch on this a couple times. I love the morality of this business. This is like truly helping, making win-wins. I mean, it's like banks have to kind of play their role, right? Banks just have to kind of be emotionless and do their thing. It's like,
yeah,
well, there's people and stories behind this. Yeah, you can have, I'm sure there's 2 buckets of stories that are very legit and stories that are, tougher to hear. But it's like, man, this is a unique space to come in, create that little Band-Aid or bridge to get someone to that next level. When it comes to, that's kind of a bit on the restructuring. I love that. The deep discount piece, you're getting these at a discount. Is this mainly, help me understand that the bank is obviously motivated, like, we need to get some money back on this. And then you guys are kind of offering, hey, we're going to buy this from you, but not at the whole amount that's owed to you, right?
Question. I get this question a lot. Like, why would bank do that? Because I think most people think, again, you can just foreclose, a bank can foreclose. They'll take back the property because that is one of the exit strategies. So like if a borrower doesn't work with us, that is an exit strategy. So the problem is, let's take Silicon Valley Bank, for example. You have a bank where they originated a ton of paper at 3%. It's now pretty worthless at 6-7% interest rates. So they have 2 options. And typically it's not even just distressed assets. They'll do both this. They'll have a ton written at 3% that just isn't making them money. That's performing. So what they do is they have really 2 options. For the ones that aren't performing, they can choose to go the foreclosure route, which, as I mentioned, banks are awful at managing debt. They don't have really departments set up that specialize in this and moving it quickly through the process. So they can spend, a year, 2 years plus trying to recoup the cost by going through the foreclosure process and just to get a payoff for the loan balance. Or they can say, you know what, we can cut our losses, package these up, some performing, some non-performing, sell them at a deep discount, and then go take that money we get and originate paper at 6%. So for them, it's like, what is the path of least resistance that's going to help us make more money? So,
okay. And it's like would you say most of these are bulk? Like you get packages of them?
Yeah, it's very rare that at this point we're buying one-offs. When I started out as an individual investor, I actually did start buying individual notes. I don't see that as much anymore. It's become more, it's really hard to break into as an individual investor in a non-fund manner. So because when COVID hit, a lot more regulations were put into place to protect borrowers against basically predatory lenders, and practices were not so above board.
Yeah, and that makes sense too. I mean, that's you said it perfectly. The bank packages these together for a dollar amount, and they're calculating the opportunity cost of going and using that money that they would get at the higher rates, right? Like let's go and put some money back to work.
Yeah.
With what we have. Okay, that makes a lot more sense, because that's a huge part of this, right, Lauren? Like this is getting them at the discount has to be a crucial factor. Yeah,
that is I'd say the factor in our success is getting them at the specific discount. And the biggest question that comes into play right now is, well, how does that work? Interest rates are so high now. When you started, they were 3%. Now we're at 7%. And my answer to that is that interest rates are really not a direct effect at all, because when we're looking at an asset, a list of assets, is something we're bidding based off a specific yield that we need to get. So for example, say we need 12%, of a 12% yield, and we see a loan was written at 6%, we'll be like, okay, we need a 50% discount. If it was written at 3%, we'll be like, okay, we need a 75% discount for this number to work. So yes, the seller totally has the right to say, absolutely not, that's outrageous, but that's irrelevant to us. We're going to bid what we know we need to bid in order to get to the yield we need.
That makes sense. Yeah. Yeah. And there's a, you're going to get a package like this, and then, that's a game that you guys are playing, and now you're going to kind of sort through. And like I said, just as an example, if you get, let's say you get them as part of this package, you got a $800,000 loan, right? Let's say they had $200,000 in equity in the property. So let's call it $800,000 property, $600,000 loan. Okay. Follow me on this. And then they stop making their payments. Okay. So the example is like, they stop making their payments. Something happened in life and they're, let's say, the $30,000 behind example. So now you're saying that $800,000 house, which is maybe going up in value or jockeying, but still around that value, you're going to buy that $600,000 loan that's behind on payments. So yeah.
Say like 400.
Okay. And so then in my mind, I'm sitting here thinking,
yeah,
you own an $800,000 asset and you bought it for 400. I mean, that math works every time.
Yeah. So that's the big, I just spoke to a group of investment advisors this weekend, and that biggest kind of selling point for them was, wow, the coverage on your assets is great. So right now, our average asset value is $400,000. Our average loan is 120 something, I believe. And we are at the average purchase price of that loan is $90,000. So we're into a $450,000 asset for $90,000. That's 4x coverage. You're not going to find that in any other asset. The security and risk there is very low. So
yeah,
we'll ask oh my God, what keeps you up at night? Honestly, not much. What keeps me up at night is more that, okay, say none of these borrowers wanted to work with us, we would be overwhelmed going through the foreclosure process. But even that would still allow us to, come out on top. It might take longer. It's definitely not our preferred strategy, and because it takes way more labor on our end, but we're set up to handle it. So it's really, that is kind of, I guess you could say, the only thing that is in the back of my mind. But even that isn't negative.
Yeah. From an investor viewpoint, which is what you guys do, you guys have a fund of these that people can participate in. I mean, I'm sitting here looking at oh my gosh, that's amazing. That hedges so much risk. And when it comes to exit strategies, so I'm understanding. Well, yeah, two is that. Two that come to mind. Okay, there's three. Yeah, explain the exit strategies. I'd love to hear. Yeah.
The first one is if we say take on a tape, which is basically a list of assets, and we take it down, and there's one in Montana. We would consider that an undesirable, but sometimes you're not allowed to cherry pick which loans you want. You have to take the whole thing. So one exit strategy is liquidating the undesirables, is what I would call it. For example, we had one in Montana that we purchased. Okay, the loan balance was $54,000. We purchased it for $36,000, and within 30 days sold it for $40,000. So quick flip and easy. We don't deal in Montana, so there you go. And that's where those relationships in the industry come into play. We know who does New York, who does New Jersey, who does second liens, who does, so we know where to liquidate. And then the second most viable and most of our portfolio actually goes into the second bucket, which is working something out with the borrower, whether that is a trial payment plan, a forbearance plan, modifying the loan, extending the term, and adding those arrears to the end. Whatever that might be, the borrower has decided, especially in this climate where rent is outrageous, inventory is low, and selling their home probably wouldn't get them enough to buy something else. So our borrowers are very incentivized right now to come to the table. And then the third option is exiting through the property, meaning the borrower has said, no way, I'm never working with you, in which route we can offer cash for keys for them to move out. We can do a deed in lieu, or for foreclosure. So even within the three main exit strategies, there's various options we can do.
Gotcha. That's really cool to hear. And I mean, with the liquidation strategy on the first one, you guys have that ability. I mean, you're taking over that note. Well, so are you able to just sell it right away? Like you can just sell it? Yeah. Or you sold the note to someone else. That's what that meant, not the property.
Correct. Yes, not the property.
Okay.
Yeah.
I had to follow that for a second. Okay.
Dollars in 30 days.
Yes. And that's kind of that flipping the mortgage type of mentality there. But yeah. And I mean, the reworking with the borrower is a huge win. You said you have a little experience with this yourself when you started.
Yeah.
I mean, I feel like this can go, in my head, it goes really, really well. And it's like, hey, this is awesome. Thank you for coming. I'm ready to work with someone. Thank you for listening. Or it goes really bad. I'm sure there's all the things in between. What's been your experience there?
Honestly, for the most part, I think it's been pretty good. I haven't had many borrowers who have said, like, I'm never going to work with you. One of the only ones that went all the way through foreclosure, almost, I think the day before, was a borrower that the borrower had deceased. No one knew the borrower had deceased. And then all of a sudden, this, I think it was a granddaughter or a niece, came out of nowhere to redeem the property and pay it off in full because she just didn't know. So that happened, but a lot of borrowers were able to, again, come to the table, commit, make payment plans, and then modify the loan. And then it's performing, which is then really mailbox money. So you're just collecting payments as if you were the bank.
Yeah, amazing. And that's kind of where I want to go just before we break here is on the site, a lot of listeners will be drawn to this part. I think that you guys kind of pay your investors and yourselves and investors in that monthly dividend income style. Is that correct? That's kind of the investment structure?
Yeah. So we do pay monthly dividends. They're considered dividends for tax purposes. So you're not going to get like a K-1. You'd get like a 1099 dividend form, which is way better for any tax situation. And part of it, we have two offerings, but the big one and the kind of passion for me was the Regulation A. Now, for those who aren't familiar with what a Regulation A offering is, it's essentially an offering that's available for us to market and to accept funds from both accredited and non-accredited investors. As someone who wasn't accredited and saw all these funds that were 50K minimum, 25K minimum, but you have to be accredited, and that's the only way to play to get in the game. The Reg A really opens it up so that anyone can get in the game. Lower minimums, again, anyone who's looking to kind of test the waters with investment experience, or to get investment experience, test the waters, and learn kind of what it's like to invest in an alternative asset, which is like the dirty word, that's kind of why we start, like, in a cliche way, I guess you could say, like, to democratize alternative investing.
Gotcha. Yeah. And I mean, I know of syndications. We've heard people talk about real estate funds. A lot of these types of investing, when people put $100,000 of their hard-earned saved money, but they have to watch it kind of grow on paper, right? Or wait till a big exit. Whereas this type of investing, you guys are kicking that, it's impacting your monthly budget. It's impacting your lifestyle.
Yeah, it was really, and I think there's kind of like two buck camps, I guess you could say, of do I invest in something like a growth option, so like a multifamily that pays me, in 7 years a big payoff, or do I invest in something that's more passive? And I think, you and I look about the same age. Our parents and parents would say, probably they would probably do what we're seeing is our older investors will say passive income all day. Like, I want to plan for retirement. I want to subsidize my Social Security check or my retirement income. And they would say to younger kids, do all the growth, they take the risk. But I think what I'm seeing is really interesting. I'm seeing a lot of younger investors, kind of the light bulb go. Like, I want to subsidize my lifestyle now, whether I could for a phone bill or daycare or a car payment. Like, if I can generate that income now, that's less time I have to work. I think there's more emphasis on living in the now than waiting for retirement.
Yes. Yeah. And I think you're hitting it right on the head. I don't think there's a lot of options that offer that option. It's most of the time you're going to the stock market or you're going to some of these funds and it's like, this is just how you do it. And it's, oh, look at the growth results. Here's our percentages. But man, to have, I was looking at the chart on your website, to have a large dollar amount and all of a sudden you've now guaranteed a $3,000 to $4,000 a month, investment. Come on. Like you're walking down the path of replacing income. And that's a really neat thing that you guys do. Yeah. So definitely that website again, 7einvestments.com, little pitch on that. There's some really cool information. So there's the feedback on that. And then we're going to take a little break. I want to come back and really dive into your guys' process for, what you guys are doing, how this is all looking, and then really for investors if they're interested. So we'll be right back with Lauren Wells. Hey gang, really hope you're enjoying the episode. I want to take just a little bit of time to highlight another episode that we have, episode 35, Freedom Through an Online Business with Sophie Howard. We shot this episode and got super excited about the offer that she had to provide, which is a community and a course teaching you how to buy an online business and create a truly passive revenue stream. When it comes to the passivity scale, Sophie's stuff is all the way 100% passive. She's living a fully passive lifestyle right now, doing things that she loves and working in businesses that she's really passionate about. And so if you haven't yet, check out that episode 35. And if you're curious about Sophie's program, there's actually an affiliate link in the show notes of that episode. You obviously get Sophie's course and her community, but it also helps us fund the operations we're doing with the Passive 25K podcast and helps us achieve our passive income goals too. So we think this is cool synergy. We think it's great value for us, for her, and for you as someone that's looking to add a revenue stream. Definitely check it out. And now back to the show. We are back on the Passive 25K podcast with Kyle Reedstrom. We are talking all things mortgage note investing with Lauren Wells. Lauren has been diving deep on fixing and flipping mortgages, not houses, not always, but they're working with borrowers and restructuring these loans, turning them into an awesome investment that can pay a monthly dividend. There's a cool stuff we're talking about. And Lauren, I want to dive into 7E, the company, your guys' company. How does that look as far as the process goes fully? I know we touched on it here and there. On your end, what are you guys doing on your steps of the process to bring it to a point where you can now offer it to investors? And then let's talk a little bit about people that are listening and saying, hey, this could be part of my strategy. This could be something that I want to build into part of my game plan. What does that look like for them, involvement? And then even after they would invest, how does that kind of look? So there's a loaded one for you.
Yeah. So when we I'd say 7E is actually, it's funny, 7E is the brand, and it's based after my business partner, Chris 7E, who was our CEO. But what's interesting is all of our funds are CWS investments. So 7E is purely the logo and the brand that all of our former investors know us by. So I get that question a lot. But really, it started with both two individuals, Chris and myself, who built our own portfolios. And then Chris started doing some joint venture deals because there were non-accredited investors who wanted to get in the game and have passive income. We then launched a few Regulation D offerings only to accredited investors. And then there was just so much demand for non-accredited investors to get in the game. That is where the Reg A came from. And it really comes down to kind of economies of scale. The more capital you have to deploy, the bigger asset list you can take down, which means you're going to get a better discount, which means then you can provide a better return to your investors. So when we were structuring this fund, the Reg A and the Reg D, it was really about, okay, what are all the things that we've seen go wrong or that we didn't like about things we'd invested in? And it really came down to, okay, we want a monthly dividend, specifically a dividend, because everyone who's invested in any sort of investment that's an alternative hates K1s, myself included. I don't like producing, though, with the accountant. I don't want to wait 8 months to receive. So the 1099 dividend and the dividend component was really crucial for us because we wanted to make it as easy on our investors as possible. We also liked the monthly aspect of it because, again, we want to help people subsidize their lifestyle. And then the Regulation A offering, of course, to give it access to everyone. Now, when we're evaluating, and I don't know if this is what you want me to, feel free.
Yeah. No, I think I want to get into that. Like, you guys now are tasked to go have deal flow. Like, you guys have to go find these things, and then not only find them, but you got to make sure that they're going to work, right? It's not. I don't know how easy it is. It's probably not just like surfing Zillow.com and looking at houses,
Yeah. So really, the knowledge and relationship and this is where that relationship capital, I think is what you called it, comes into play. The mortgage note space is a very, very small community. You have your BlackRock, Blackstones, but in this kind of level arena that we're playing in, it's very small and neat. There's, who the sellers are, who the buyers are. And that comes from having done this and built and gone through the buying and selling process so many times on your own that you kind of build like your personal brand of, okay, these people are serious. They're following all the licensing requirements and servicing rules. So it's not going to blow back on me as a seller. And they're going to close. They're going to be able to close. It's kind of like for real estate. If you have two buyers and you've worked with one before and they're quick, they're easy, they close, you're probably going to urge your seller to go with that one because the deal will get done. So we, sourcing wise, it's been a game of relationship building with sellers, whether it's whole loan traders, credit unions, other funds that will lead you performing and want to float off their non-performing to us. And to kind of give you an example, the biggest things are, okay, can we raise capital and can we deploy that capital quickly into assets? Now, the raising capital part has gone extremely well. The deploying capital has gone well as well, but I want to kind of paint a picture of what we've seen over this year. During Q1, we saw about 300 million in assets come across our desk. In Q2, we saw about 300 million a month. In Q3, we're seeing about 300 million a week come across our desk. We cannot keep capital in the door long enough before it's already committed to something else. So what's different about our fund is when you're investing, you're like, okay, this is the portfolio. I'm not investing in a concept of, hey, we're going to build a multifamily property here. We're going to build a grocery chain. We're saying, hey, look, this is our portfolio. We have 130 assets in 29 states. The total asset value is 55 million. Here's where the states are. Our loan to value is something ridiculous like 30%, and our investment to value is hovering just above 22%. So people can see what they're investing in. No, they're not going to see like a picture of all 120 whatever properties, but they'll be able to see, okay, like they already have an active portfolio that they have built. And then from there, it really then just goes down to the investors as far as the way our company is set up. And this was, again, done very purposefully, is there's no management fees or acquisition fees or disposition fees where basically you're looking at a fund, you get 20% and 10% of that is fees. We did, again, to make it very much like investors get paid and there's no other like senior lien or anything additional. So we also don't take any capital or any debt. We don't have any loans. We never have. We don't anticipate new, because it just doesn't make sense. We don't need to. So that's kind of how we do what we do. And then, even more granular, when we get a list of assets, it's kind of like, again, the house buying a house. We're not just saying, here's our bid, and then like cross our fingers. We need to make sure that the trust but verify kind of is our saying. Like, we trust the information the seller is giving us, but just like you would if you're a buyer, you're still going to have an inspection done. You're still going to walk through the property and look at that inspection report and say, these 3 things I want credits for, seller credit. So we do something similar. We give an indicative bid on assets based off of value, location, and our overall buy box, high level buy box. And then once the seller accepts, we have a 3 to 4 week due diligence process where we pull title, make sure it's a first lien, make sure the value is accurate, look into the borrower. I mean, if a borrower is a serial bankruptcy filer, we're not going to move forward with that. That's someone who clearly knows how to cheat the system, and it won't really be advantageous for us. So, the due diligence process is something that I could probably spend a whole episode on talking about. But yeah, so it's kind of like a 2-part. And then after we've asked for either to drop loans or fade bids, we close and then board those assets into our system.
Cool. And, I think a couple things came up for me in that. I mean, I think a lot of people are going to ask me this question after this podcast, which is, I like what I heard. I want to get into this. But really, Lauren, your advice on like a normal person that's not part of, doing this themselves or a small group, it sounds to me like the way you're getting the positive returns is really because of the high level relationship you have with these banks, funds, the sellers, and you guys are able to do that because you've reached a certain status. So, I mean, going with a fund like yourself obviously has the benefits of, it's much less risky than someone DIY-ing this thing, right?
Oh, yeah. I mean, we do get a lot of people who come and they're like, hey, I want to build a note portfolio. And, Chris does have a membership group where he kind of walks through and teaches people. Half those investors say, wait, this is much more active than I thought it was. I'm just going to invest with you. And I honestly, if you're not investing in performing, if you're doing any sort of non-performing investment, which is where the greater returns are, it's going to be a lot more work than you think and then you have to know the rules, the regulations around servicing a note, and, you can't self-service. You have to have a licensed servicer. So there's other fees that eat into your profit. So I think 20 years ago, it would have been super easy to get into it from an individual perspective. I'm not saying it's impossible. And again, Chris has a membership group where he lets people kind of listen in to his process and everything. But yeah, I think that when it comes to investing for someone who's maybe looking at their first investment, I would say to anyone to get on a call with not just whoever is their, kind of team of not advisors, but hey, here's the answer to your questions, but actually try to get on the phone with the sponsor, talk to them, get a feel for them. Chris and I are both very hands-on. I actually, until about 2 months ago, was taking every investor inquiry. We're kind of growing, and so I have a team. But yeah, I think it's really about doing your due diligence on the sponsor. That's I think the thing people don't think about the most is, thing can sound super great, but how is the sponsor going to react when something goes wrong? I don't think we'll get into the industry to try and screw people over, create a Ponzi scheme, but you never know how someone's going to react and what's their communication like. What kind of reporting do they provide? So all those things are things that I would definitely just, always look into whenever you're looking at investing with any sort of alternative.
Yeah, that's really
so this is something that came up. I was at a conference with, like I said, over 200 investment advisors. There is a huge, if anyone listening has an investment advisor, go to them with it. If your investment advisor is not looking into alternative assets, in kind of sticking to that 60-40 rule, you're their client. You can push them to invest in alternative. And there is a greater demand now of advisors kind of showing up saying, wait, the 60-40 thing's not working. It's not long-term. It's not going to be successful for a majority of my clients. I need to look into other ways of investing. So I think that's always a leading indicator of the kind of advisors are looking at it. And I think we're going to see a lot more people, individual investors, starting to look into the alt space here shortly.
Yeah. And, on that note, you guys have an option. And I know you had an option on your site describing, hey, using IRA funds to, position with 7E. I don't know if a lot of people understand or know exactly that's possible. Is that just self-directed IRAs, or it's like you're pushing your advisor to do this?
Yeah, no. So we do accept funds from like self-directed IRAs, and Quest, Madison Trust, Advanta, all of those self-directed custodians. But we are currently actually working as well to get on the Schwab platform, which would open up this to that many more people. So.
Yeah, no kidding. Where you can go and say, hey, you're the kind of the person, the guy or girl that's managing my money, and I'm saying, hey, I want to get a little more aggressive with something like this. Can we look into that?
Yeah.
Now you're creating your little team to do due diligence in companies like this. I think that's great advice.
Yeah.
And, touching on the deal flow increase, it's a little ominous the way that you said it, because it's like, whoa, that you went from, a week. It sounds like deals are just flooding the plate, which tells me there's a lot of bad mortgages out there. Is that like, give me not bad's the wrong word. There's a lot more deals that are coming your way. Quick, like maybe macro vision explanation. What is this? Is this the future? Are you just going to see this continue to increase?
I honestly think it's going to pick up in Q4 because we have a lot of government programs that are ending, which is going to put people in a position to figure out how they're going to pay their bills, whether that was, a daycare subsidy they were receiving, student loan payments are going to becoming due again. So we're going to probably start seeing an uptick in default. So of that 300 million, about only 20% are non-performing. The rest are performing. So
there you go. Okay.
Old because, again, they're at 3%, 4%, and rates are at 7%, and that doesn't make sense for a bank. But we're also seeing a lot of bridge debt that is coming under fire.
Yeah.
People who out bridge loans are trying to consolidate, and the bank wants an arm, a leg, and their firstborn child in order to put it into one loan. So there's a lot of opportunity definitely coming down, the pipeline. And it kind of is a very big change from COVID, when what's weird is we saw record refinances. We were getting payoffs from borrowers left and right because of the low interest rate. And people were selling because they were like, wow, my house has doubled in price. So, and I'm not paying, so I can get rid of all my debt and cash flow. So, and put some cash in my pocket. But COVID, what it did too is, because there was record refinances and because less inventory was available because of like government moratoriums on foreclosures and moving at all through any sort of legal interaction with the borrower, we saw significantly less inventory. And because of that, the acquisition price was way up. So we're seeing that acquisition price just get chipped away at more and more as we go through this year, which is great, again, for funds like ours.
Yeah, and that was my error and assumption there was, it's like you said, 20% are in that category of like they're struggling to pay the mortgage. The other majority are it's just a strategy for the bank or a fund, which again, interest rates probably were like a little bit of music to your ears, like saying, hey, we might see a little bit more of this influx.
Yeah.
And that might be more of the same for the future with a lot of those refis. What's on the horizon for you guys? I'm curious, what's the future hold? Where are you guys? Is this kind of steady Betty keep in your lane, or you guys got bigger aspirations?
No, so I feel like we're just scratching the surface. We launched this fund a year ago. We've raised just under 20 million to date from retail investors, meaning we haven't even tapped into the broker dealer or institutional market yet. So right now our focus is really continuing to help retail investors and individuals who are interested kind of get in the game. And so we're kind of pushing a lot on the education front. I think a big passion of mine is the education around alternative investments for anyone who is walking to the grocery store. So really our marketing will be more geared towards educating around just passive investing in general. So I love this podcast. You should probably come on ours. And then, what is a mortgage? And then on the institutional side, really, getting agreements in place with broker dealers who have hundreds or, thousands of advisors who are looking for assets like this. So we kicked that off in June, and it's going really well so far. There's been a lot of great feedback. And I think someone put it best, and they're like, you're bringing a relatable asset class to the masses. Because if an advisor is explaining to their client, hey, I want to invest in XYZ, whatever it is, they should be able to describe what that asset is. If you're trying to describe an oil and gas deal or depreciation on a multifamily over years, it's so complex. There's so many things that go into it. Everyone knows what a mortgage is. Everyone can understand what it's like to get behind on payments, or like the concept is easy for people to grasp. And so the feedback has been, you're providing like a risk-adjusted return on an asset class that everyone knows, which makes you feel
100%. And when you break it down, and it doesn't take long, like you said, your 3-minute video, it's like, okay, I get this. This makes sense. How are some key parts working? On the investor side, I just want to get into like, if people are interested, right?
Yeah.
Individuals interested. What does that look like? I think you mentioned a call, getting on a call, but how about some of the fundamentals like minimum investment and how that looks?
Yeah. So if people are interested, definitely go check out our website. There's like an invest now or speak with a representative option. The whole process is automated online. Even if you do speak with us, the minimum investment is $5,000. And then we start offering what we call bonus shares at $25,000. And those tiers increase. And what that does is it just increases your total return at the end of the 4-year lock. So it is a 4-year lockup, meaning your funds would be there for 4 years. You can choose to redeem prior. There are penalties if you choose to do so. But yeah, so it's $5,000, 4-year lockup, and the return is 8% annually, paid in monthly dividends. So, yeah.
That's awesome. Just taking some notes. And again, the website there to find you guys best. You also mentioned a podcast, so I want to let you give a pitch on that. But your website is 70investments.com. And then where else can people find you or follow what you guys are up to?
Yeah, so invest.70investments.com is actually our offering page. So you can go there. That 3-minute video, that's still at the top. And you'll see kind of all the terms and how to get started if you're interested, or to speak with a team member. And then or honestly, I'm on LinkedIn. I feel like LinkedIn is like such an untapped marketplace to connect and with like-minded individuals. So I love speaking with people. So hit me up. Fun fact, you can leave voice messages on LinkedIn. That's like the way to get through to people, because people are totally caught off guard. They're like, wait, what? Okay, that was a total aside. And then our podcast is the Creating Wealth Simplified podcast. So we interview just different asset classes, syndicators, people who are raising capital or have left their W-2 job and created a passive lifestyle for themselves, and kind of share their tips and tricks with everyone.
Cool. That's awesome. I hope the listeners out there's not a lot of these types of really neat alternative investments that start at a $5,000 minimum. This is such a cool door you guys are opening. And then, like you said, bonus shares at 25. I think this is a real opportunity for a lot of our listeners to add in, or at least underwrite and kind of analyze as part of your game plan. Lauren, this conversation has been a blast. We've never talked about this stuff, so I really, really like when we can bring this stuff to the podcast. So cool. And it helps people. That was my favorite part. This is really neat what you guys are doing. I'll end our episode like I always do. The audience, what's one action step you can take based on what you heard today? Don't wait. Action is key. And if you're currently on your passive income journey, reach out to us. Tell us your story. We truly believe that we can accomplish financial freedom better together. This has been another episode of the Passive 25K podcast with Kyle Reedstrom. If you liked what you heard today, I encourage you to subscribe to our YouTube channel and like this video so we can get more of these conversations out to people that are curious about starting their passive income journey. And if you are thinking about starting your passive income journey, the next steps are to go to our website at p25kg.com and hit apply. This will get you into our application to join our community called Passive Income University, where you can learn everything there is to know about starting and completing your passive income journey. Thanks again for tuning in. I'll catch you next time for another conversation on the Passive 25K podcast.